Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to Jamie Constable of Singers, one of the UK's finest capital markets experts. So welcome, Jamie.
Hello, Paul. Great to see you again.
Lots been happening since we last spoke, probably about 5 or 6 weeks ago. We've had sort of like now we've got record or multi-decade inflation highs. We've also got bond yields in the US and the UK returning to pre-pandemic levels. So what's your sort of like broad take on equities for the rest of the year?
Well, I think, equities are doing pretty well, all everything considered, let's be honest, particularly the FTSE, and we'll come down to the kind of our end of the market, the small and mid caps a bit later. But I think equities are doing pretty well, considering that you've got US 10-year now at 2.9%, UK just looking like it's going through 2% today, and the 10-year and the 2 years 2.47 in the US and 1.58 in the UK. If you consider that and the huge moves we've seen in the last 6 weeks, equities are doing pretty well against that.
Yeah, bonds aren't doing too well though.
No, you don't want to be in bonds. Let's be honest. And with US CPI, as you say, 8.5 and UK 7, we have got that inflation issue. Now, what I would actually, we're starting to talk about, has US CPI peaked now? Maybe it could go a bit higher, but I do think, and I think we've discussed this before, once US CPI starts rolling over, the year-on-year number I'm talking about, I think we could well see a bit of a rally for growth stocks on the back of that. It depends what yields do, but I mean, getting up to towards that 3% now on the US, I think we could see a bit of a rally in the summer in the growth stocks. So we shouldn't, throw the baby out with the bathwater here. There's growth stocks out there, and they've all been hammered now, of course. So there's value coming in the market out there. And as we say, I think equities, led by the FTSE, of course, by the financials, the commodity stocks, oil, have led the market up. So the FTSE is not doing too bad, but it's a little bit more, obviously, damage down at the small.
I think you've got to be a stock picker though when it comes to sort of tech, because yes, a lot of them have really sold off hard, but frankly, not all of them are going to bounce up a great deal. I mean, you've got the sort of the ARC innovation funds, the Cathy Wood sort of stuff, which are really sort of long duration type assets, and we should never have got to valuations that they did, because they were sort of like, pumped up a great deal by Cathy and other commentators. But equally, you do have a number of ones which have been sold off, which look like attractive valuations with long-term secular growth trends and reasonable valuations. So they're your classic. It's the GARP stocks that you're looking for, I think, isn't tech?
It's paying the right price for a stock. 2022 is all about paying the right price for a stock.
Okay, well, you've just set yourself up perfectly there, Jamie. Talk us through some high conviction plays then.
Well, I think some stocks we like the look of at the moment. So one I'd start with is RPS, and you can also maybe include Ricardo in this space as well. Consulting engineers, okay, they're going to see wage inflation. We spoke to the company recently, RPS that is, so they're probably seeing about 5% wage inflation. But it's an inflation world we're in now. Any company you speak to, are you passing price rises on? Yes. Are you being successfully doing it? Yes. So the world is ready for price rises now. We've got into that situation now. So what COP26 and what Ukraine has really driven to, squared, quadrupled, whatever now is energy security, shortening supply chains, investment in your local production, reshoring, nearshoring. Now, to do that, you need consultants who will help you do it. What does RPS do? They have transferable skills in their consultants. Maybe they were doing oil and gas, and maybe they'll be doing some oil and gas again now. But if you want to store hydrogen and you've got an offshore old gas depository, you're going to put hydrogen into it, you need offshore engineers to actually check it all out, do all the calculations. If you're going to put offshore wind in, floating wind, you need people who are experienced in wind, waves and everything like that. Well, again, RPS have those because they were doing the offshore oil rigs, gas rigs and everything like that. So that's a company we like, and Ricardo similarly more on the
just on RPS, what sort of valuation would you put on it? It's currently trading at what, 102p, etc. What and a market cap of 285. What sort of like valuation?
Well, we think
your analysts.
It's not being valued for growth at the moment. People don't expect it to deliver too much growth. Now, one thing about inflation is inflation helps to delivers you growth to start with. I mean, if you're starting with putting your fees up by 7%, say 5% plus a bit of on top, then you've already got 7% top line growth to start with. Now, if you add in some growth in the market as well, I think this could easily do double-digit growth, and the stock is certainly not being valued to do that. So
what's it currently on then? What valuation is it currently on?
I haven't got the numbers to hand at the moment.
Okay, sorry.
Sorry on that. Sorry on that one. I haven't got them, but it's not on a high valuation in the market. From memory, it's on around 12-ish times or something like that.
Right. Okay.
But it's not a highly valued stock. So again, we come back to paying the right price for stocks again. So there we've got one that has pricing power. The skills of its employees are transferable. It's one I'd look at. And similarly, got Ricardo in that space as well. So
yeah. I think you're right. I mean, certainly if you've got tech plays and energy, that's only one directional, that is, because if nothing else, Ukraine and Russia has taught us that we need to get off the dependency for Russian oil and gas, and therefore it's going to accelerate that whole development of renewables, electrics, and also nuclear. And I know you've mentioned that before in terms of, you know, Rolls-Royce, but equally we've had quite a few good contract recent news from, I think it's another Singer's client actually, which is Avingtrans. And they've been knocking out the ball in say nuclear. And I've asked actually, and here's a stat that you may not know because I've sort of like dug a bit more, but their exposure, if you look at group turnover, it's about 40 to 45% in nuclear at all parts of that supply chain. So not only the extension of the useful life of existing facilities, and then also the decommissioning of nuclear facilities with their storage boxes, which where their meat, you know, their bread and butter is, with all their aftermarket services. But also they do now supplying in pumps and real critical parts into new nuclear, which is that small form for Rolls-Royce. And also there's a leading nations project out in France as well, where they're on. So they've got it all covered effectively with nuclear. And the other one I would say, which came out with the great prelims, is Northbridge Industrial, which is changing its names to Creschick. It's now come a full 100% load bank business that really serves uninterruptible power supplies. And the key point that investors need to take away with Northbridge is that historically it used to do critical backup supplies, testing and commissioning of them, which were off grid. So that was your mining, your marine, oil and gas, etc. But now on top of that, they're doing on grid uninterruptible power supplies, and that's to supply things like data centers, Nightingale hospitals, because if you've got more reliance on renewables, then your network grid stability is more effectively more unstable, and therefore more institutions and more critical power supply places need their own backup supply, which is basically what's driving all of the the load bank. So they're now a perfect play for that. And again, you know, I mean, I would say, I mean, just from my valuations, Avingtrans is on about, I can't remember, 420 or something like that, and I've got minimum sum of the parts of 540. I think Singer's is about 510. And Northbridge, I mean, the shares have done well at 180, but I actually think the market's got it wrong in terms of the analyst views, and I think they're worth at least 145, if not a lot more. And I could easily see in direction of travel well above £3. So I think all of those in terms of Ricardo, RPS, you know, Avingtrans and Northbridge are all in the right spots of energy as we move from the oil and gas dependency, particularly on Russia. Now, I know you like a bit of cosmetics as well, isn't it? Even though you're looking very pretty, I see you like these.
You've been to the sun there yourself.
Yeah, I know, but you like affordable.
Just on Avingtrans again. I don't know whether you saw the other day, but South Korea basically said they're not going to close down their nuclear power stations. So that's another plus. I mean, people are going to keep their existing going. And as you say, in the longer term, you're going to get new ones built as well. And the one thing about nuclear is there is a massive lack of expertise globally. So the value of that expertise is only going one way, and that's got to be up. So, but so on the cosmetic side, I think what we're talking here, you know, the consumer's under pressure this year. We all know the consumer's going to be under pressure. So finding value amongst consumer stocks is going to be harder. But people will be trading down, and you want to be involved with companies where they're expanding their addressable market. And certainly Warpaint is one of those. They're broadening their base both in the UK and the US. A number of retailers in the US. They've announced 6 more recently. They haven't named them all yet. They've got Boots and Tesco in the UK. They've got their W7 brand. So they're broadening the base that they're supplying to. So you've got top line growth anyway. It's a value for money brand. So, and it's not a lookalike, but it's a value for money brand that basically offers quality cosmetics at a much cheaper price. So they will benefit from trading down as people trade down once the consumer disposable income is squeezed as it is being. So we like that one as well. They had a good trading update recently.
A very good trading update, didn't they? I mean, they blew the numbers to pieces, I think. Yeah,
so good trading update, upgrades. The key for me on that one is that broadening of the base of the customers they're supplying, both sides of the Atlantic. That's what you want. You want someone who's got a following wind already and momentum in the business, rather than someone that's fighting to stand still, which is obviously a lot more difficult from that point of view. So that's one.
Just on that one as well. I mean, a similar company which is slightly higher sort of kudos on brand. It doesn't supply the supermarkets, but supplies the sort of like the more of the beauty pharmacists and beauty chains, etc. Is Revolution Beauty, and that's knocking the ball out the park in both the UK and in the US, and it supplies the likes of Boots here, Superdrug, but also Ultra Beauty, and there's I think there's a couple of other big retailers out in the States as well. And likewise, they're growing their top line, big, strong double digits. And they're another baby in the bathwater stock that people should look at with good pricing power. And, when it comes to sort of like challenger brands, I mean, you've got quite an old, staid industry, the likes of, Unilever and P&G and I can't remember the other ones, but basically they've been around for years and years and years. And these challenger brands, Warpaint and Revolution Beauty, their innovation cycle is a lot shorter, and they can launch products far quicker, and they can get feedback from the consumer through their digital channels to be able to tailor that product to the person at time. And as I say, they haven't got to take stock risk either, and their retailers haven't got to take stock risk, which is more importantly. So that's why they're seeing, very, very high growth. And I would say, with Revolution Beauty, again, when it comes to valuation, I know their house broker have got a 200p price target. And I think the shares last time I saw was about 110, 120.
Yeah, the write down. Yeah. So I think both those are good kind of value for money pricing power in what's going to be, let's be honest, it's going to be a bit more of a difficult environment for the consumer looking forward.
Well, the thing is, people get back to the offices, they'll need makeup. If they want to go out for a party, they want, they need makeup, and even the blokes, even this is a proper tan. It's not false.
Same as mine.
Yeah, exactly. Yeah. So what else do we like?
Well, I think the other one you've got inflation, so you want stocks that can be a hedge against inflation. Again, we're talking pricing power there. Yeah. So one of ours is we IPO'd it last year, Artisanal Spirits, probably more well known as the Scotch Malt Whisky Society. Yeah. So you've got an appreciating asset there. So each year, I mean, you might have seen in the Sunday papers the adverts for buying casks of whiskey and stuff like that. Well, this is the preeminent kind of club, as it were. You basically join as a member. It's quite interesting. You join as a member and you pay £65 to be a member. Their cost of customer acquisition is zero because they get that back on the first order generally.
I'll tell you an interesting observation as well, just on top of that to drive it. I mean, most people know that. I mean, when you and I were around, it was sort of like Bacardi and vodka. Now it's obviously, it used to be gin it's gin for the last 2 or 3 years for spirits. Yeah. But actually, particularly in the States, whiskey and Scotch is going, is really gaining in popularity. And do you know why? It's the Peaky Blinders.
Yes, because from Birmingham,
and it's absolutely, taken off in the States, and they just drink Scotch, whether it's from Scotland or from Ireland. So
and they've got some. There's a big American, actually. It's quite interesting. You mentioned America and whiskey because it's in the plans for Artisanal to launch a US version of the Scotch Malt Whisky Society, because there's so many local producers in the US now. They'll be able to do that. So looking to duplicate what they've done in the UK, and well, globally, to be fair, in the US, but using American whiskey. So that's obviously a huge opportunity. They haven't launched it yet, so there's nothing in the share price or anything for that or anything on that. But why do we like it? It's an appreciating asset. It goes up each year. Inflation's good for them. Strong model. They've got they've got their kind of bars in the UK. It's a global business, so you're not just exposed to UK consumer trends, but also premiumization, as we all know, is a big trend. People are drinking better. They're drinking less, but they're drinking better. So people are willing to pay that bit more. So they have pricing. They very definitely have pricing power as well. So I think a nice.
I would agree, and even better, you can test the product and try it,
and
can't
you can test the product,
which is great. Which is very much the same as CBOX, because it came out with a year-end trading update this morning. And again,
saw that,
and the shares have been sold off. They were above £4 only about sort of 4 or 5 months ago. They had a sort of like an online blogger from ShareScope, I think it was the guy, Maynard Payton, who had a go at it, who had a go at the stock, and it's driven that down. And then likewise, there's been fears going forward of how sort of like how fickle the consumer is in terms of whether it's going to decide how discretionary the product is, etc. But I mean, I've spoken to the CEO, Suk Chamdal, which is a video even this morning. And it is it's a super durable, highly resilient product, because people won't scrimp and scrape. They might save a few bob on things like, the finest shoes and whether they sort of like decide to go on have their 10th coffee sort of stuff. But when it comes to sort of like family celebrations, they're still on a decent cake or very nice cake. And, they're still on a very good growth trajectory, top line, like for like, going at 12%, plenty of cash. And I did the valuation.
The franchise model as well, isn't it?
It's 100% franchise model.
Yeah.
And I mean, when you do the valuation, etc., I mean, the shares are roughly, they were just below £2. I think they're up a bit more than £2 now. I mean, I couldn't get anywhere less than, I think it was 285 to 340, as a pence per share, and that's modest, and it could go a lot higher because they're obviously, they've been, if you look at their historical track record. And another baby in the bathwater, which I think is a Singer's client, is Venture Life, and I know you've spoken to, but the CEO, Jerry Randall there, I mean, he put out another statement, and unfortunately, the company's auditors have been.
That's not uncommon of late.
It's very common.
There's a lot of companies where this is happening because the auditors, especially with Omicron because they haven't got, people have to isolate when they get it and whatever. So they just run out of personnel to go and do it. So it's not an uncommon to see.
No.
And he's reiterated guidance as well. That's the key thing.
Yeah, exactly. And I mean, I just say it isn't their auditor's fault. It's just basically they haven't got enough resource on the ground to actually finish the audit. So that's just they're putting the results out in May. But I expect them to reiterate, for 2022 guidance as well. And on the back of that, I mean, everybody's got the shares I last saw were 37p. You've got Simon Thompson at Investors Chronicle, who reckons it's worth £1. You've got Senkos, who on the upside case it's 127, and I think Singer's last were about 48p. So if you did the average of all of those sort of target prices, you're looking at still double where the current price is. And they've only got modest amount of debt. I mean, I think they've it's less than a half times EBITDA. So I mean, they're not in any.
It's all about delivery there. I think it's all about delivering the numbers, getting that growth. Obviously, you had the hiccup with that Chinese distributor, which they've changed now. So they've changed them, so they got the new one in. So it's about delivering the growth there. And I think that's what as you say, there's a lot of stocks have been hit down hard, but within that, there's going to be stocks that are worth looking at.
And just finishing on that consumer side, look at a lot of the retailers of that. It really has been sort of the the epicenter of all the damage, particularly on the sort of the online. But you've got some, and they've all been sold off. But I mean, two which have sort of come to the market over the last sort of year, which they're best in class, run by really highly entrepreneur founders and leaders, would be Marks Electrical. Basically they're effectively a much smaller version of AO World, but effectively have a much better supply chain model than
they're
AO
more
World.
they're more at market as well, aren't they? I think they're more.
Yeah, they're more at market, but they've got basically a target. And I've spoken to the founders, Mark Smithson, on numerous, and the CFO is great, Josh Egan, etc. And they're going for 10% market share, and they've only got just over 1%. And if they do that, then when you drive the numbers, you get over a £6 share price compared to around less than even £1 at the moment. So plenty of upside there. And likewise with Lords Group Trading, which is basically they're 80% of that turnover is in repair, maintenance, improvement. It's not, it's not new build, etc. And that's always been pretty resilient. And they do have pricing power. I mean, you just look at Travis Perkins and Wicks and stuff. They've been pushing prices up because it's still a very, very strong market. And I think even on a very conservative valuation, I get over £1.30. The shares are around about £1. So again, it's picking through in those areas that you've got just arbitrarily sold off for really no fundamental reason, because the business has got a different model that they're delivering against, and a different motivation, and a different, they're starting from a different place.
And I think it's interesting, you mentioned companies like Marks and Lords Group Trading. Effectively, they're distributors at the end of the day. They're not manufacturing anything.
No.
And if you think back to when we had inflation, distributors are a great place to be.
Yes.
Because if you've got 7% inflation like we've got in the UK at the moment, and on building products, it can be a lot higher than that. If you've got inflation, you get stock profits.
Yeah.
And also your top line is growing anyway. So, I mean, inflation can hide a lot of ills. Now, if you've got good management and inflation, now you have to be a little careful here. And Next will be the example I give here. Now, don't get Next is a great company. So I like Next. It's a really good company. But they're talking about growing the top line by 5% this year in their guidance. Now, the guidance is always conservative. But within that, they're going to put prices up by 3% in the first half, and somewhere over 6%, maybe over 6% in the second half. So actually, volumes are falling within that, is what, when you look at that. So if that's what's happening, you have to run your business very efficiently, because your top line's growing because of inflation effectively. But you've got to be very efficient at how you run it. Otherwise, your overhead's going to be too high. But I'm sure Next will run that Next will be able to do that because they're an extremely good management team. But inflation gives you growth to start with. That's the thing. So we just need to remember that inflation is not necessarily a bad thing. I mean, what sectors do well out of inflation? Property does well out of inflation, and not so much. House builders to a degree, depending on how high it goes, but the property does well. So look at some of the property stocks maybe that are on quite big discounts still. If you look back to the 70s, I mean, one year in the 70s, house prices nearly doubled in a year. I chatted to my parents about it. I mean, I don't think we're going to that. We're not going to that kind of level.
You raise a very good point just for investors, because they just need to sort of they see headline numbers of GDP being lackluster and these bandied around terms called stagflation. But if essentially you do have inflation at roughly 7%, then nominal inflation at 7%. Then that is what, it's nominal terms is your EPS for companies. It's not real GDP terms. So yes,
real GDP is obviously low, but
I know, but a lot of investors get that mismatch. They think because the economy is going south, then actually earnings will go south. But it's not necessarily on a nominal basis, in a real on that realistic basis. So
especially if you've got pricing power, it's all about that pricing. You've got that pricing power. You're putting your prices up. You should be able to grow double digit. Now, I don't. Inflation. Where does it go back to? I think we should maybe. I don't think it goes back to 1 to 2 here. I think we probably go back to 3 to 5, something like that. But actually, 3 to 5 inflation is reasonably healthy. I don't think that's particularly a problem for the economy. It's much better for equities than it is for bonds, which we've spoken about at length. You want to be in equities when there's something like this. Which brings me to the point I was making before about once we see that CPI year on year start rolling over, which in the US, I think it might have been a bit earlier, but Ukraine's pushed it out of it, to be honest. But it could be kind of, where are we now? The April number in May, maybe May number in June. And the UK is a little bit different because you've got the energy price rise to come through, which means the UK is going to spike up. But once that US starts rolling, I think we could see growth stocks. So having a bit of a rally. Now, the US tech or growth is a bit different to UK. UK tend to be profitable companies, growing reasonably fast. Whereas in the US, as you said, the Cathy kind of stocks, there's a lot of loss makers in there, and you're bang on. When long duration, loss making stocks with bond yields high are not the right. You don't really want to be in those. But the stock we really like is a stock called Calnex. It's like a mini Spirent. Why do we really like it? It's had a long train of upgrades. It's in testing of 5G networks. Then you've got all these other operators coming in doing into that market, whether it's called, you mentioned data centers, etc. All these, they need to test everything all the time. But it's about synchronization is their specialization. So in very layman's terms, because I'm very much a layman on this, you're sending bits down the line. You've got to make sure that all the bits come together at the right time at the other end. You can't have, and the tech person says to you, you can't have the future coming first, which means obviously bits get there too quickly. But anyway, so synchronization means you get it all right.
Do they do? Is it fiber optics or is it wireless?
It's all to do with it's 5G and all to do with that. So it's all fiber optics nowadays.
Yeah. Yeah. Okay. That's what I thought. Okay.
So what happens? What they've got some technology that is in test with one of their largest customers, which is the multinational global tech company. And there's a one page on it in their latest presentation, if you go to the latest presentation, which it provides a multiple speed advantage. Look, and we're talking multiples of speed. So that could mean that you need a tenth of the data center capacity, or you can get 10 times more out of what you've got.
So who do they sell to? The data center?
Oh, it's a big point. But actually, Spirent, they distribute some of their stuff to Spirent, but it's to all the people, whether it's a Google or a Facebook or all these people, and all the different people in that space. So
it's not the equipment. It's not the equipment providers. It's basically the actual data center.
No, it's testing. So basically, they're rolling stuff out and stuff like that, like Spirent does. So Spirent's a much bigger company. Spirent might buy Calnex, but an old adage: never buy for the takeover. Calnex is a great stock. It's got results next month. There's been a string of upgrades, which I wouldn't be surprised to see more upgrades coming through. And then you've got this potential technology game changer there as well. So it's a really nice little stock that we like there.
I mean, I was just looking at it. Obviously, I'm not sure when it listed because I'm not familiar with it. It's ticker CLX, market cap about 145 or 143 million. At 164p. It's growing its top line nearly 30% per annum. That's what they're
upgrading as well.
Yeah, exactly. It's obviously, well, it's profitable, as you say. It's got it reckons it's sort of like nearly 6p per share profitability. So it's trading on round about 28 times, but on a PEG ratio, that's probably not far from 1 actually. Because
exactly.
So how much do your analysts reckon this is worth then? Because I mean, it's gone up from. I'm just looking here. Back in in mid last year, it was high 90s, and it's now 50% higher.
Yeah, I think it's the upgrade. You see, if you're growing 30% per annum and you maintain the rate, and you're getting 30% share price appreciation in the year. But if this technology takes off, it could be a real game changer on top. So I think we can see at least 30% on top of the share price on a 1-year view. Then you've got the optionality in there of this new technology that, again, one page in their recent presentation. They're not making a big thing about it yet, but it could be a must-have for everybody. So it's a UK technology winner. They did a small acquisition last week of bolt-on, bringing more technology in. So it's got cash flow to do that as well, which then, of course, they will put out to all their customers from a small company. Then they can actually just the whole kind of scaling up, they can then scale it up and sell it to all their customers rather than a small company would have been taken years to get there. So it's a really nice company.
When did it IPO?
It must have IPO'd about 18 months, 2 years ago, maybe a bit longer. I lose track of time nowadays. Called it's old age, I think. But it's a really nice company. Think of Spirent and what Spirent sells, in terms of testing equipment and all of this. This is in the similar space.
Right. Okay. Yeah. No. I mean, looks great story. And as I say, on a PEG ratio, I'm not sure exactly what it is, but I would guess going forward, it can't be much more than 1, which looks reasonable value for such a high tech, fast growing business, I'd have thought.
Yeah. And that's what I think. We shouldn't forget that there's going to be stocks out there in tech that are still worth owning. But it's about finding the ones where you've got the growth, finding the ones where they've got innovation is driving that growth, secular growth, data centers, speed, all this kind of thing. It's going to keep on going. That's not stopping by anyone's imagination. And then they've got the pricing power to be able to sell their products at the right prices. So we just have to be careful about not throwing the baby over the bathwater, as you said earlier. And I think the relative buoyancy we've seen in the FTSE will come down to the mid cap and the small cap and these stocks. And as we've said today, I mean, there's stocks to look at out there. And as we said, you don't want to be in bonds. No,
and you sound far more bullish than you did only 6 weeks ago. So,
well, I think it's not easy. Let's be honest, it's not easy. A lot of the private clients, people who watch this, or maybe have stepped back from the market, but that provides the opportunity, doesn't it? That's why the stocks are down. That provides opportunity. And are we going to get a recession? I don't know. It's kind of the central banks. Maybe they're walking a tightrope. We all know that they've made their policy mistakes. And it really shows up now. They made those policy mistakes because we've got inflation 4 times the target in the States. Europe, it's not far off that as well. And in the UK, 3.5 times what their target is. That will, by the annualization effect, come back. But I mean, it settles in 3 to 5. I'd be quite happy with that. And that's a great environment. And that's a great environment for equities again then. So as long as we can find stocks and pay the right price for them, we'll do well.
Well, I hope you stay positive. So thanks very much again, Jamie, for your time. Absolutely fabulous stocks for people to have a good research and dig through, and look forward in hearing how those businesses progress. So take care. Thanks very much, Jamie.
And you. Thanks a lot.
Bye.